Welcome to The Explainer. Now, if you're an investor, the steel industry can seem like this massive, complex, and honestly kind of intimidating beast. But today, we're going to change that. We're going to build a complete framework for analyzing these industrial giants so you can understand how they navigate a really tough market to create real value. All right, here's our game plan. First, we'll get right into the core problem every single steel company has to deal with. Then, we'll look at the two main ways they try to solve it. After that, we'll peek into the future with scrap and sustainability, and we'll wrap everything up with a super practical checklist you can actually use.
So let's start with the big one, the fundamental challenge that really defines this whole sector. This is the problem that dictates almost every major decision these companies make. And it all boils down to the very nature of what they sell.
This, right here, is the central question. See, at its heart, steel is a commodity. That means a steel sheet from one company is, well, it's pretty much the same as a steel sheet from any other company. And that creates a huge, huge challenge when it comes to making money.
And what that leads to is this critical reality. Steel companies can't just wake up and decide to raise their prices. Nope. They are what we call price takers, which means they pretty much have to accept whatever price the global market sets. This just crushes their ability to control their own destiny on pricing and puts a relentless squeeze on their profits. And this chart, wow, this really shows you where that pressure comes from. China is producing over half of the world's steel. That means their actions basically set the global price. So for steelmakers everywhere else, like in India, they have absolutely no choice but to keep their prices competitive. That puts a very tight lid on any potential profits.
Okay, so if you're stuck in this low-margin commodity trap, how in the world do you get out? Well, that brings us to the first major strategy companies use to escape. It's all about changing the game from being just a steel producer to becoming something more, like a solutions provider. It's all about the power of value addition. So what does that even mean? Well, instead of just selling a simple, boring slab of steel, a company takes that slab and transforms it into a custom solution for a client. We're talking specially coated steel, pre-cut parts, you name it. By doing this, they're no longer selling the same thing as everyone else, and they can finally start charging a premium price. Think about it like this. You can sell a bag of flour for, a small profit. Or you could take that same flour, bake a custom 3-tiered wedding cake, and sell it for a much, much higher margin. It's the exact same principle, just with steel instead of flour. And this isn't just theory, okay? It's happening right now with the big players. Look at Tata Steel. They aren't just selling some steel for trains. They're delivering the entire seating system. Or JSW, running these specialized factories for very specific high-value products. They are moving down the value chain, getting closer to you and me, the final customer, and grabbing more profit along the way. Now, this all sounds great in theory, but how can you, as an investor, actually tell if a company's strategy is working? Well, when you're analyzing a steel company, the first thing you need to do is check how their product mix has been changing over time.
You've got to dig into their annual reports. If you see consistent growth in sales from their value-added segment, and this is the important part, growth in profitability too, that is a massive signal that their strategy is working and they're building a real competitive advantage.
All right, so making special products is one way to boost margins, but there's a second major strategy that attacks the problem from the complete opposite direction. It's not about what you sell, it's about how you make it. This is all about ruthlessly controlling your costs through a really powerful idea called vertical integration. Vertical integration basically means you own the whole shebang, every single step. You mine your own iron ore, you generate your own power, you own the trucks and trains, you even run the ports. This gives a company incredible control over its costs, protecting it from all the crazy swings in the market. And logistics, this is a key battleground. I mean, moving these massive quantities of raw materials and finished steel all over the place is unbelievably expensive. So let's see what the big players are doing about it. Listen to this. These aren't just little side projects. These are major strategic assets. JSW literally has a whole other company that's a massive port operator. Tata's moving a huge chunk of its stuff on its own private rail network. This is all about attacking and minimizing one of their single biggest costs. Okay, so we've talked about how companies operate today, but now let's shift gears and look at the future. Because a huge technological and environmental shift is creating brand new challenges and brand new opportunities. The entire industry is being reshaped by recycling. This technology, the electric arc furnace, or EAF, is an absolute game changer.
Instead of starting from scratch with iron ore in these giant traditional mills, EAFs can just melt down scrap steel from old cars, washing machines, anything to create new steel. It's the heart of recycling, but it totally depends on having enough scrap, which has some very strange economics. And this is where things get a little weird, but in a really interesting way. With most things, right, the more you buy, the cheaper it gets per unit. Bulk discounts. With scrap steel, it's the complete opposite. The supply is limited, so as more companies build these EAFs and fight over that same pile of scrap, the price actually goes up. It's a classic supply and demand problem. And don't think for a second this is some small niche technology. EAFs already account for nearly a third of all the steel made in the world. As more old steel products reach the end of their life in the coming years, the supply of scrap is only going to grow, and this recycling method will become even more important. So, we've gone through the core problem, the two main strategies to fix it, and a huge trend shaping the future. Now, let's put all of this together into a practical checklist that you can use for your own analysis. This table right here, this is your core tool. When you're looking at a company's financials, you want to calculate these ratios. The input and freight cost ratios, they tell you how well their vertical integration strategy is working. And the debt-to-equity ratio is absolutely critical because building steel mills costs billions, and these companies often have a lot of debt. Use these numbers to see if a company's story matches its reality. When you boil it all down, everything we've talked about, efficiency, recycling, and sustainability, is pushing the entire industry toward a massive, massive transformation. And that leaves us with the final big question for you to think about as you watch this sector. Will the industrial giants of today, the ones built on digging ore out of the ground, be the ones to successfully pivot and become the recycling champions of tomorrow? The companies that are investing heavily in this new technology and locking down their scrap supply, those are the ones preparing for the future. And as an investor, figuring out who those companies are might just be the key.